Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Good to be with you and with our listeners.
Bob, as usual, we love to answer listener questions. Today's question comes from Caden in Mississauga, Ontario. He says, the major stock market indices have all doubled in value coming out of the Great Recession of 2008 and 9. Morgan Stanley, one of the largest finance firms in the U.S., recently stated that they anticipate a 350% growth in the S&P 500 by 2038. Wow, what a crystal ball they must have. If this holds true, does Bob believe such an increase is primarily due to a weakening dollar, hence inflating the cost to purchase stocks, or primarily due to new innovations?
Yeah, Caden, that's a very good question. Yeah, some indexes have doubled just from March a year ago when they were trashed. But this one about Morgan Stanley, 350% growth in the S&P in the 2038, that reminds me of end of 1999, and some institutional guy was talking about the Dow going to 35,000 from then, and I fortunately was getting along well with the editor at the Financial Times, or the Financial Post in Toronto then, and put in an essay about 600 words pointing out that what that guy was doing was extrapolating a growth rate of 12% or something like that to end up with. So it was just all extrapolations, and I pointed out that the market had become highly speculative. The dot-com bubble would not last forever, and indeed it blew out that March. Now I don't know what method Morgan Stanley is using, but it does seem to be extending the line straight up. And yes, it would have been built upon continuing to weaken the dollar. And new innovations, well, they're talking about the S&P, and new innovations are not usually in S&P stocks, so that would have been more NASDAQ type of stuff. But what we have in the market the last 2 days is a very serious hit to most commodities. And of course, the theme for a large portion of this year has been that with the Fed getting even more reckless than it's been over the last few years, that, inflation, the 1970s type of inflation was back, and those unpleasant times, I recall, it was dreadful because the costs were rising faster than wages were, and it's just a horrendous problem. And then what we are now in is inflation in financial assets. And as we often argue, once the great financial bubble is over, then virtually all prices head down. But very timely question.
The U.S. Fed strongly hinting that interest rates could rise sooner than later because of their inflation concerns. Is that a concern?
Hey, it's a way behind the market concern. You've got people talking about strong commodity prices, and they've been going down, like the key ones, copper and lumber, have been going down for 5 weeks. And then this week got hit unusually hard. So if you've got, like I think earlier today, soybeans were down 8% on the day. And some of the indexes we follow, like the agricultural index, it was down something like 4%. Base metals were down something like 4%. Crude oil we got to 72, I guess, on Tuesday, and it's backed off to 70 or something like that. So it's been a very dramatic hit to the hot commodities. And it's also timely because our work done in January was that the good times could roll right into mid-year. And there was another item we used in January, Jim, and that was that in November, the rate of growth in New York Stock Exchange margin outstanding had reached a certain level. And then when that hits, you then do a count, and some 6 months later, the stock market may do a peak, and 6 months later is May. There were a number of sectors going straight up, absolutely recklessly straight up. So, and also with it, some very fine moves for copper and for some of the grains. But as each one reached a peak, we pointed out that this has been the best action for copper since back with the 2008 boom in commodities. So you have to put that in historical perspective and point out that, and then also at the same time we're getting the full tout that inflation is on, it's going to run for as far as the eye can see, and actually what was happening is that the story very quickly got into the market, and should we consider that the last buyer bought a few weeks ago? Actually, I think May the 10th was the high for, and 10th and 9th and 10th was the high for these things. And at that same time, it was also a pretty good low for the bond future. So the last couple of days, Jim, in commodities has been a very important hit. And our view was that the good times could roll into mid-year, and this hit, which is substantial to commodities, is saying that perhaps the good time is over. So what we want to look at is that lumber, for example, that thing went from $275 in March 2020 to $1,700 in May, and now the contract is well below 1,000, down into the 900s. That's a hell of a drop, and you've had a terrific drop in copper as well. So what our theme has been is that the good times would prevail to mid-year, and then in August we would start to look for the seasonal lows in some of the key commodities, and let's just list them. Hey, we don't have to wait for August. This break is important. So lumber can have a low in October, copper in November, and crude oil in January or February. And in looking at the degree of speculation so far this year, my guess would be that those lows, those seasonal lows as they come in, could be quite on the dismal side. Because, there's certain symmetries in the market where the more straight up it is, the more straight down it goes, or the greater the degree of speculation, the greater the hit. Those sort of things are happening. So our wariness that might have come in August is here. This is a time to be wary. And you could even say that this hit this week in commodities has made us cautiously pessimistic on the business cycle, on the stock market cycle, and on the credit cycle. So very interesting times, Jim.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, U.S. IPOs have hit an annual record in less than 6 months. Why are so many people anxious to get their stocks listed?
Oh, because of the party. You can raise money at tremendous multiples of earnings and book value and that old-fashioned stuff. And then because of it's a party, there are many people buying new issues. And in a hot new issue market, gee, they come out and they double and triple and do things like that. It's I still prefer, I'm old-fashioned, Jim. I still prefer call them new issues, new stock issues. And they can be fabulous, and it was also a feature of the very first bubble in 1720 in London. It was called the South Sea Bubble. And there were so many, I think there was something floated in London, some historians put it together years ago, that over about some 480 new issues. And as it was coming out in the first early part of 1720, the government had its quasi-government South Sea Company, and it had all kinds of warrants and options outstanding that they wanted to get exercised because indirectly it was putting money into the treasury. So they saw the amount of new issues coming out and the amount of money going into these new issues. So then they came in with the Bubble Act, and it virtually banned new stock issues. But nonetheless, the South Sea stock peaked at they say that it traded at £1,000 late in June of 1720. It dithered around in the summer and then crashed in the fall and went all the way back down, I think, to £100. And that's a few years earlier where the play had started at about £100. So these things are amazing when they're on, and then when they crash, they're also amazing. But it's worth noting, Jim, that as they occurred in London, which was the financial center until New York became the financial center, each of the 5 bubbles, the 5 great ones to 1929, peaked in May or June. So there's a real seasonality there. So it's possible that this great global bubble, and I saw a headline yesterday that the World Composite Stock Index was approaching new highs. This could be it. It's really fascinating times. So that, and we're going to emphasize, Jim, that this year, and we're not yet fully 6 months of the year, has set a record amounts of new issues being done annually. But this is just not quite the first 6 months. So, hey, it's fabulous. Wonderful stuff.
Paul Tudor Jones says hedge funds should bet heavily on every inflationary trade. What does that mean?
Oh, yeah. Paul Tudor Jones has made $1 billion. He's been he started as a trader in commodities and then became very successful hedge fund operator, and decades ago we had him for an account, so this is where it was interesting, and he's been really successful. And that headline was just the other day, and it was actually to everybody to get long the hot commodities, the inflation bets, everything else. So I thought it was surprising that a guy as experienced and successful as him would get aboard. But it's the old thing, as people learned in the 1970s that the Fed was reckless and that issuing credit depreciated the currency and commodities would go up. But they never really seem to understand that the same game's been going on when you're in a financial party, and it's the same thing. Monetary expansion, currency depreciation, but not in so much inflation in tangible assets, but huge inflation in financial assets, of which we'd had. The gain in the Bitcoin, for example, has been without precedent, and particularly so with an item that has such a large capitalization. And then now you've got the whole of the crypto game, and there's huge amounts of money gone into it, which could disappear forever. So it's been a privilege to be alert and playing in this fabulous party. And I, for one, am going to be kind of disappointed when it ends, but every financial party ends, and that's the problem. And this hit to the commodities is just kind of like a preliminary wake-up notice. The credit spreads, which is the difference between high-grade and low-grade bonds, they've been narrowing tremendously. If you take the CCC, which is extreme junk rated against treasuries, it came down to just a little over 6% spread a couple of days ago. But if you look at something else, which is junk divided by the bond future, the bond future based a few months ago and has been quietly going up in price, down in yield, while the yields for junk has been continuing to decline. So what's happened is that the credit spread as measured by J&K and the bond future actually has been rolling over, and this week got hit. So I'd expect that the calculation of other spreads will begin to widen as well, and this is the one that is the party conditioner. The spreads narrowing is very good for speculative markets, and spreads reversing to widening will be very, very difficult. So we're watching this one very closely as well.
Poultry prices are soaring. What's the story?
Yeah, just the headline, Jim. Poultry prices are soaring. I don't have a chart on them, but maybe the headline should have included that poultry prices are flying, but that would be a pun, wouldn't it?
Well, chickens don't fly all that well.
No, they don't. And we're going to get a cartoon I had drawn a few bull markets ago, and it was what we're looking for now is and it relates to chickens. It's going to be the greatest cluster cluck in history. So we'll get the cartoon out later today to our subscribers. So.
And from poultry to turkey, turkey troubles point to emerging market problems.
Yep. That sort of came out in March, where Turkey, South Africa, and Argentina, where suddenly their central banks had run out of reserves. So short rates rise and their currency goes down. So that was one problem. And then now there's another mention of this. And it's interesting, Jim, because going back to 1997 ended up being a financial hit. It was called the Asian crisis. And it started in Thailand on July 1st of that year, when their markets went into turmoil. The Thai central bank had run out of reserves, their short rates went up, their financial markets went down, the Thai currency went down, and then immediately the other central bankers said, this is isolated, there's no problem. A week or so later, it hit the Philippines. And at that point, they were saying, oh, but it can be contained. And then eventually known as the Asian crisis. And then when it hit New York in that September, it didn't roil the stock markets too much. But I remember a headline that it was the worst month for the U.S. corporate bond market in a decade. So what the instruction has been is that if you're in a highly speculative global market, the problems will appear in lesser exchanges or lesser countries first, and then they will work their way in and eventually hit the senior exchanges, the senior financial centers such as New York or London. And when's the probability of that? Usually in the fall. So this, we'll watch now to see if other countries over the next few weeks have similar problems where their central bank runs out of U.S. dollar reserves. So, again, something to watch for, Jim.
Yes, and something interesting as well, the International Monetary Fund says it will not back El Salvador's bid to use Bitcoin as currency. So they're dangling out there on their own.
Oh, yeah. I don't fully understand or got the details on that one, but they somehow said they would settle accounts in Bitcoin, and I think it's too wild an item for that. I think the world needs a huge liquidity senior currency that shows relatively little change in purchasing power. And yes, there have been some bitcoins or cryptos out there that are designed not to change too much in purchasing power, but it's all getting very complicated. I saw a headline as well that China government is going to get rid of many, or if not half, of the crypto operations going on in China. And I don't recall the details of that. I just grabbed the headline and thought that, oh yeah, these cryptos are taking a huge amount of electricity to operate. And Harvard Business Review a while ago figured out the amount of electricity annually used is equivalent to what Sweden consumes. So it's huge amounts. And what's it for? Speculative counters, chalk marks on the board. This truly is a form of madness. Now, not to knock it all, Jim. If the wizards running these things come out with a very large market cap Bitcoin that maybe they do it convertible to gold, that is relatively constant value, it will be doing the world a service, but actually it could be done a whole lot easier just by having the senior currency, which is still the U.S. dollar, be declared equivalent into a fixed amount of gold. And then that then diminishes the ability of the central bankers to go crazy. So, I mean, the central banks are crazy. One, they think that expanding their portion of the credit markets pushes up the economy, but it doesn't. The money goes into whatever the speculative game is, which is lately financial assets. And then the other is that it just doesn't connect to the economy. So to push that idea, and the public, if we go into a severe correction in the financial markets, the public is going to look at the amount of money, taxpayer money, that was poured into the markets hoping to keep things going. And when they're not going, the public can condemn the central banks. And then the other thing is that going back to the formation of the Fed in 1913, the rationale was that with the Fed there as lender of last resort, they would be able to fix a pending credit crisis, and they all then knew that you had a credit crisis and it was always followed by a recession. So the Fed would prevent credit crises, and that would prevent recessions. But since 1913, there has been 18 cyclical recessions. So clearly, and as attractive as it is not to have recessions, the theory and practice does not work. So this is where scholars then can get very critical about the crazy workings of the Federal Reserve System and other central banks. And then the public's going to look at a disaster and say, hey, you've been wagering our taxpayers' money on fraudulent theories. So, Jim, it's going to be very interesting.
Bob, thank you so much for chatting with us.
Hey, good to be with you, and we're looking forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He loves to answer your questions, and you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.